Welcome to our Taking Stock video for the week ending the 8th of September 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Equities Analyst, Daniel Ortisi, to stream to you all things share market. Welcome, Dan.
Yeah, thanks, Ken. The dust has settled for reporting season, so it'll be a chocked pack episode today.
It certainly has settled, Dan, but we continue to be quite busy looking for opportunities, and we'll speak to some of those opportunities later. But before we get started, just a quick yet important reminder that the information we provide during this episode is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, and any charts or tables we present shouldn't be relied upon as a guide for future performance. Well, with the reporting season done and dusted, Dan, it's now a great time for us to really reevaluate our portfolios and prepare for the year ahead. And our portfolio optimizer allows you to conduct a portfolio review to ensure the stocks in your portfolio are not only aligned to your investment objective and risk tolerance, but also ensures you are not exposed to unnecessary risks with unhealthy companies. And the optimizer, it also enables you to rebalance your portfolio so you are not so concentrated to any particular stock. It's a disciplined way of really taking profits, especially across stocks that have rallied strongly following their results and deploying those funds into those oversold opportunities.
Speaking about opportunities, Ken, even though the reporting season has ended, the research team is, of course, continuing to work hard to identify some emerging opportunities for our members. And over the next few weeks, there should be a few more stocks coming into our Star Stock universe. In the meantime, however, you can find some of these emerging opportunities yourself by referring to Tim's growth or income filters with potential. Otherwise, you can, of course, build your own filters using our golden rule metrics, including financial health, past financial performance, and obviously outlook criteria. Some of the emerging companies we currently have a look at include analytical software business DUG Technology, electrical product distributor IPD Group, payment service provider SmartPay, and minerals testing business XRF Scientific.
Yeah, some very interesting names with very strong financial metrics there. But last week, Tim and I, we spoke about some of the reporting season themes, and one of those themes is around the uncertainty in the outlook guidance, which has led to downward revisions to corporate earnings expectations. And the economic data released this week has added fuel to this uncertainty. For instance, the RBA has kept cash rates on hold at around 4.1%, with bond markets suggesting that we are near the peak in the interest rate cycle. But inflation in July is still running at an annualized rate of 4.9%, and that's still well above the RBA's target band of 2 to 3%.
That's right, Kian. And meanwhile, Australia's GDP data released during the week showed that economic growth continued by 0.4%, which was actually above market expectations. However, when we drill a bit deeper into the numbers, we can see that consumer spending has weakened further, while tight employment rates and high wages are continuing to put pressure on the cost of producing goods and services.
Yeah, inflation is certainly sticky, Dan, and this suggests that we should remain cautious, especially across those discretionary spending sectors, following the strong share price rally across those retailers during the reporting season. And these include stocks like, for instance, Premier Investments, Accent Group, Nick Scali, Temple & Webster, and even Kogan.com. But we believe the rally across these stocks is temporary, with these businesses reporting a slowdown in like-for-like sales growth and pressure on their net profit margins. In fact, we've already begun to see the share price reversals across some of those higher quality names, including Breville Group and Lovisa Holdings. Okay, now for some Star Stock highlights for the week. Star Income Stock and Utilities Company, APA Group, they release results in line with market expectations, revealing a 2% rise in annual dividends to 55 cents per share. The stock is usually considered a defensive business, but its share price has been under significant pressure over the last month. Dan, what has contributed to this?
Yeah, that's right, Ken. And if we actually take a look at it, the bulk of the underperformance came prior to its report, and that can really be traced back to some of the things we've previously mentioned. Key point being the RBA and the US Fed meeting a few weeks earlier, suggesting that further rate hikes were potentially needed to control inflation levels. APA was sold down as it is considered almost like a bond proxy due to its defensive cash flow forecasts. In addition to this, APA conducted a $750 million equity raise to purchase Alinta's Pilbara assets at a discounted price of $8.50 per share. The Alinta assets operate energy transmission and generation across the Pilbara region that caters primarily to major mining companies. The deal allows APA to expand its revenue base and leverage off growth opportunities, including electricity grid expansions, transportation, and storage of renewable energy as well.
Yeah, in the end, APA ended up paying about 1.7 billion for Alinta. That's translating to a price to earnings multiple of around about 14 times. So the market does seem concerned about whether this price is too expensive, especially considering that Alinta comprises a portfolio of older gas-fired power stations.
That's right, Kien. And some of the risks around overpaying for an asset can lead to future write-downs. And we've seen this during reporting season with unhealthy business iris. Despite this, the acquisition is backed by a large tangible asset base and has predictable cash flow. So there should be less risk around the valuation, giving these firmer assumptions. We do note that management has lowered their FY24 dividend payout ratio to retain more capital, and that's to fund its existing growth projects, such as the Western Outer Ring Main project or the East Coast Grid capacity expansion. Currently, APA is on a gross dividend yield of around 7%, with the expected payout ratio lowered to around 54%.
Wow, that dividend yield at 7% looks quite attractive for a defensive play there, so perhaps an opportunity there. But speaking about share price pressure, drilling services provider Star Growth Stock and Star Income Stock, DDH1, previously received a takeover offer by a mining services company, Perenti Group, the code's PRN there. But since then, it has underperformed. Dan, what has been the driver of this one?
Yeah, it has been a bit disappointing, Ken. And as we flagged back in June, the deal only consisted of around 12 cents per share to be offered in cash, and the remaining amount was to be provided by scrip. Hence, the share price of DDH has also fallen in line with the share price of Perenti. Now, that's been under pressure from geopolitical uncertainty in West Africa, where it has a significant amount of its revenue based, and also a weaker than expected cash flow result for FY23. In addition, drilling activity overall has slowed, and that's due to a slowdown in junior mining financing.
And it looks like the deal will likely go ahead with support from the board. And if the shareholder vote proves successful, then the execution date will be on the 6th of October. But Dan, it looks like we won't be covering this stock after this. Perenti is roughly double the market cap of DDH. So the merged entity will be weighted towards the fundamentals of Perenti, and it has more debt, much lower profitability metrics under Golden Rule 2, and does not pay a dividend as well.
That's right, Ken. So we do have a few concerns there, but we'll continue to watch and monitor the company also. Now switching over to the corporate calendar, with reporting season now majorly over, it will be a quiet week in regards to results. However, Star Income stocks that are expected to go ex-dividend are on the Thursday, the 14th of September, DDH1, which is currently on a gross dividend yield of around 9%, and Spark New Zealand, which is currently on a dividend yield of around 5.4%.
Now for Under the Microscope. This week, we take a look at business that is also meant to have defensive cash flows. Supermarket chain and Star Income stock Coles Group. However, following its results, the stock was sold down heavily after it missed market expectations due to a 10% jump in costs driven by wage pressures, theft across its stores, and cost blowouts with regards to the construction of its Ocado customer fulfillment centre.
That's right, Kien. And of course, this has led to a contraction in its annualized net profit margin, which has declined to around 2.56%. Previously, it was around 2.75% over the last 6 months. Coles continues to face these margin headwinds, with suppliers now requesting further price increases, rising payroll taxes, and also the much needed investment in security and artificial intelligence to tackle the rise in theft.
Yes, theft has certainly been an issue, especially for a lot of those US retailers. But despite the heightened risks around these costs, we have retained the stock under coverage because we believe the recent share price decline has more than factored in these risks. And dividends are expected to fall to around 6.5% per share from 66 cents per share. But we believe this is a temporary blip as the company recovers from cost headwinds. In addition, once the Ocado delivery centers come online, it will help alleviate some of those capacity issues. As a result, dividends are expected to recover to 68 cents per share in financial year 25.
That's right, Ken. If we actually look at the gross dividend yield, it's trading at around 5.5%, which does not appear too unattractive given the defensiveness of the business. Longer-term investors could potentially see this recent retracement as more of an opportunity, given that the stock is now trading at a decent discount to consensus price targets. Key drivers for growth include the shift towards in-home consumption as interest rates hit consumer budgets, and the growth in private label brands, which could potentially offset some of the margin headwinds they're currently experiencing.
But those who are not comfortable with facing those cost risks with Coles may want to consider investing in Woolworths. The supermarket chain is currently on a slightly less gross dividend yield of 4.3%, but has delivered stronger profit margins. In addition, Woolworths has stated that their food retail sales growth for financial year 24 onwards to date remains strong at 6.5%, and this should provide support for the rise in free cash flow and future dividend payments. And now for question of the week. The reporting season has been a time where there has been quite a few star stock changes. So a useful question for investors this week is, how can members monitor all those star stock changes during the reporting season?
That's right, Ken. And of course, to keep track of these star stock updates and also company announcements, members can refer to the latest star stock update section, which is under the research homepage. To get more detail, click on the View All button, and this will take you to the recent updates and announcements page. You can also access this page under the Tools menu and clicking on Recent Updates. Here, you'll be able to monitor star stock recommendation changes, and by selecting all companies, choose a time frame, say 3 months due to the recent reporting season, and then select star stock recommendation changes. The tool will then provide you with a list of all of our recent star stock recommendations and changes.
And also for future star stock changes, you can monitor this under the Alert Manager. Here you'll be able to set a star stock change alert and have the option to process this intraday or receive the alert via email. And the Alert Manager also allows you to monitor other changes, including earnings revisions, director holdings, ex-dividend dates, and technical breaches, such as when the share price breaks through the SD30 TSR. That's all we have time for today, but thanks, Dan, for your insights.
Yeah, thanks, Ken. Good to be here. And obviously, even though reporting season's finished, still a lot of work to be churned through. So hopefully a few updates in the coming weeks.
Yeah, I look forward to receiving some of those opportunities because our members will appreciate it. But just a reminder that our Lincoln Live webinar is on Monday. So please come along to ask our panel of experts on stocks, portfolio strategy, and also how to use Stock Doctor. To summarize today's episode, with reporting season over, it's an opportune time for you to reevaluate your portfolios and look for potential growth and income opportunities and avoid those unhealthy businesses. And you can do this using Stock Doctor's Portfolio Optimizer and stock filters. And many retailers, they have rallied strongly on the back of better than expected results, but we remain cautious of this sector due to ongoing heightened risks with weak consumer spending. Take care and have a happy, healthy, and prosperous week ahead.